Cathie Woods was recently in the news for doubling down or at least going further into her AI push. And that's something that I do want to cover in this video. And so let's go. What's up, guys, and welcome back to the channel. So you can see right here that Cathie Wood has actually boosted her stakes in Microsoft and Facebook. And essentially what she's saying is that she's adding to her bets on these US mega technology firms that are tied to AI. And we're seeing that a lot right now, where a lot of analysts have even come out and said, hey, we're going to try and increase the price targets for these names that are tied to AI, because there seems to be a lot of potential revenue that can come from this space. But anytime I see this kind of thing, I saw it with the EV push, I saw it with mining, maybe a decade ago. Every time there gets so much excitement to a particular field, I always like to pause and just say, hey, this might not necessarily be the right opportunity for a potential value investor, because, a lot of the earnings or gains are expected on top of already high valuations for these companies. And so that's what I want to show you, because I really think it's a buy expensive, in the hopes that the company earns so much more earnings that the price that you paid, which seems expensive today, may not necessarily be expensive in the future. And I understand the game here, but it does make me scared a little bit. And so here's what the article goes on to say. ARK's next generation internet ETF, which actually beat the NASDAQ 100 this year, bought 8,800 shares of Microsoft on Monday of this past week, in addition to the shares that they purchased in March 20 of this year. And then the other thing is, separately, the fund also bought 10,000 shares of Meta after a gap of 5 months. And of course, you can see here that they now hold 51,000 shares of Microsoft and 285,000 shares of Meta. So what a huge bet on Meta. And you guys may recall that I would say Meta and Microsoft are currently trading at 52-week highs, if not all-time highs. I'm not really sure about the all-time part, but I definitely know that they're trading rich right now. ARK's investments demonstrate that Cathie Wood is super confident in her theme. Remember, guys, that she's a very thematic type of investor. She doesn't necessarily focus on valuations. It's more just where does she expect that theme to go and take these companies' earnings. And so she believes that the artificial intelligence theme is very important. And so I get it, but at the same time, the article even points out that the rising valuations have raised the bar for the sector's earnings. And that's just a nice way of saying that I think it sets up the potential for a disappointment. AI is definitely in favor right now. Companies have been saying the word AI or artificial intelligence in their conference calls more and more. We saw earlier this year where Alphabet's valuation actually was penalized because they were not saying it, I would say, as much. I mean, they did not have the same push into AI as early as Microsoft did, so that's why their valuation suffered a little bit. Since then, they've somewhat caught up. And so, again, a lot of hype in this area. As soon as there's any sort of insane amounts of hype, I generally tend to walk away, and this might be one of those situations. But I don't just want to say that to say it. What I want to do is I want to show you the valuations that I have for Meta and Microsoft that are in the tracker that all the Patreons get access to at that low $5 a month tier. And so let's take a look at Meta. And so with Meta, the current company price is around $331 per share. I'm having it valued at $300 per share, so just slightly more than what I believe its intrinsic value is. And so they really have to create value here. Now, can Mark Zuckerberg create value here that I'm not seeing? Absolutely. And this is what I'm seeing. And I'll freely admit that I tend to be very conservative. And so for 2023, I'm assuming an 8% increase a 10% increase in revenue for 2023, which I think is aggressive already. And then, I stay in the double digits beyond 2023. So I already think that that's aggressive. In order for you to be comfortable with the current price and think that Meta is undervalued, you would have to forecast much higher revenue growth rates, which I think is what Cathie Wood's team is doing. But the challenge there is that Cathie Wood likes to target, and she said this previously, that she likes to target a 15% long-term annual rate of return? Well, in order to do that, you have to assume that Meta is going to double their earnings over the next 5 years. And I'm not saying that they can't do it. I'm just saying that the revenue growth rate that you're going to have to assume and the cost containment on expenses, you're going to have to assume a lot to get to this valuation. And so I just don't see it, but I might be wrong here. And so you guys let me know if you do see it and why. Where am I getting this wrong? Now with Microsoft, similar story actually, right? I'm using a high multiple. And so their current share price is $372 per share. I'm valuing them at around $260 per share. So they're very much ahead of where I think they're valued at. Look, they're trading at 42 times next year's earnings. I think that's really rich. So you really have to believe in a very aggressive thesis in order to make Microsoft make sense for you, at least in my opinion. But once again, I'm not a super expert here. I could absolutely be wrong, but let's take a look at what the revenue forecast looks like for Microsoft. So you can see I'm less aggressive on Microsoft. It's such a big company already. However, I'm still in the double digits for 2024 and beyond. You can see that right there. And so, a lot of that double digits is just coming from cloud, right? And so, AI may impact these other segments differently. I don't know. I'm not smart enough to know. And so, once again, I think that this one is very valued at a very healthy clip. I don't see an opportunity here where you're going to see a 15% annualized rate of return on these shares. But once again, I might be wrong, but 43 times earnings seems very rich to me. And I always like to find people who potentially disagree with me, just because, I get things wrong all the time, right? And so Joel Fishbein, I apologies for not pronouncing his name appropriately, initiated coverage on Microsoft with a buy rating and a 3-year price target of $600, which is a 60% increase from the stock closing price as of the date of this Barron's article. And he's saying that his view is led by his optimism about the company's future AI innovations. And so they view it as the fastest growing multi-billion dollar market in technology. Now, I've heard that before. I heard that about cloud slowed down. I've heard that about many industries. EV is now slowing down. Even back, just being Canadian, there was a time where oil was very fast growing. Even before then, in the early 2000s, mining was all the hype. Even before then, there used to be a company in Canada, it still exists, BlackBerry. Their share price was through the roof, and people thought that, BlackBerry would own the whole market, as it kind of did at the time. But all I'm saying is that there was a lot of hype. And so in order to justify the valuations that we saw back then and the valuations that we're seeing now is a significant increase in revenue and earnings. And I'm just not willing to bet on that. And so that's my position. I really think Cathie Wood is super intelligent. I really like her approach on thematic investing. I also follow a theme type strategy, but I tend to focus a little bit more on valuation. Look, I've been right this year, especially with Gap and Foot Locker, where the theme was that these businesses are probably not dead into perpetuity. Retail will probably still exist in some way, shape, or form over the next 5 to 10 years. And so the valuations that were suggesting that these companies were going to be closer to closing like half their stores or whatever, that probably just didn't make sense. And we were and ended up being rewarded handsomely. The same sort of theme existed for the banking sector, where people thought that it was going to be all blood, and I just didn't see that happening. I thought that there was a potential for a recovery. There was a greater than not likelihood that the increases for the interest rates would not be as fast and as high as they were previously, and obviously that ended up being right because inflation is now starting to come down. So all of those banking investments paid off heavily as well, and so it did well. So these are also examples of thematic investing. It's just a different type of themes that I follow. But once again, I highly respect her. I'm not trying to knock her at all. I've never tried to really knock her. At least I don't think I have. I might have, just based on valuations. But I want to know what you guys think. Do you think that she's right? Do you think that AI could push the revenues for these companies so high that they're trading cheap at the moment? Let me know in the comments below. I'll respond to everybody as I try to normally do. I'll leave it there, and I'll see you guys later.